This week, the Dow closed above 50,000 for the first time in history. And then 24 hours later, it closed back below. 5 trading days. A historic milestone. A historic reversal. And a regime shift in what the market expects from the Federal Reserve. Here's the week that was. Let's start where it started. Monday, President Trump rejected Iran's peace proposal on Truth Social and called the ceasefire on life support. The peace trade we tracked 2 weeks ago was officially dead. And yet, the S&P 500 and Nasdaq still closed at fresh records. Yardeni Research hiked its year-end S&P target to 8250, up from 7700. Wall Street strategists upgrading targets at record highs. Monday's lesson seemed clear. The market had decided what stories it wanted to hear, and Iran was not on the list. Tuesday changed that. The April Consumer Price Index came in hot, well above expectations. And the market reacted, but selectively. Chip stocks got hammered. Qualcomm fell 11% in a single session. Micron dropped 3.6%. Defensive stocks like Walmart and United Health rallied. Bond yields climbed. We said that day the warning signals just got real. The signals we had been tracking for 2 weeks finally started moving prices. Wednesday tested that thesis hard. The April Producer Price Index came in even hotter than CPI. The biggest monthly wholesale inflation print since March 2022. Annual wholesale inflation hit 6%. By every analytical measure, this should have been worse for stocks than Tuesday. Instead, the S&P 500 and Nasdaq both hit fresh all-time highs. The bond market reacted. The 10-year Treasury yield climbed to 4.5%. But equities didn't care. The chips that fell Tuesday rallied Wednesday. We called it a single stock cluster rally, powerful enough to override every other signal in the market. Thursday delivered the milestone. The Dow closed above 50,000 for the first time in history. Cisco surged 13% on earnings. Cerebras, the AI chip company, exploded 75% on its IPO debut, the largest pure-play AI IPO ever. The Trump-Xi summit produced reassurance that China would help keep the Strait of Hormuz open. Every story the market wanted to hear came together in one session. We closed that recap by saying the milestone was real, and so was the fragility underneath it. Both things were true. Friday answered which one mattered more. The Dow lost 537 points, dropping back below 50,000. The S&P 500 fell over 1%. The Nasdaq fell over 1.5%. Chip stocks that led Thursday's rally led Friday's sell-off. Intel down 6%. Micron down 6.5%. AMD down 5.5%. Nvidia down over 4%. And Cerebras, which exploded 75% on its Thursday debut, gave back 10% on Friday. A 24-hour round trip from peak euphoria to peak unwind. That's the week as it happened. Now here's the week as it actually was. This was the week the rally cracked. Not crashed. Not collapsed. Cracked. There's a difference, and the difference matters. What broke this week wasn't the market. It was the consensus about the Federal Reserve. A month ago, the odds of a Fed rate hike this year were 1%. By Friday's close, they were 45%. From 1 to 45 in 30 days. That is not a small repricing. That is a complete reversal of what investors expected the Fed to do. And it happened because the data forced it. Hot CPI Tuesday. Hotter PPI Wednesday. A blowout Empire State Manufacturing print Friday, the highest reading since 2022. Every economic data point this week argued the same thing. The economy is not cooling. Inflation is not finished. The hawks just won the argument. And under that, the warning signals we had been tracking for 2 weeks finally hit price. Treasury yields rose all week, ending at the highest level in a year. The Dow transports continued their divergence. 2/3 of S&P 500 stocks declined Wednesday, even as the index hit a record. The Schwab note about December 1998 to March 2000, the only historical precedent for record highs on this narrow A base, was published Wednesday and looked prescient by Friday. None of these signals were new. What was new this week is that they finally started mattering. Friday was also Jerome Powell's last day as Fed chair. Kevin Warsh takes over starting next week. So the central bank transitions leadership at the exact moment the market is repricing for the hikes Powell never delivered. The new chair walks into a much harder problem than the one his predecessor was managing 6 months ago. So what does this mean heading into next week? 3 things to watch. The first is the FOMC minutes from the April 29th meeting, which release Wednesday. Those minutes will show the detailed discussion behind that 8-4 dissent. With the market now pricing hikes, the tone of that discussion matters more than it did when it happened. Hawks may have been right all along. The second is Nvidia earnings, also Wednesday. The AI trade that drove records Thursday and unwound Friday hangs entirely on this print. Nvidia either bails out the bulls or confirms the reversal. There is no middle outcome. The third is whether Monday opens with a bounce or a continuation. Friday's sell-off was big and broad. Markets that fall hard often see reflex bounces within 48 hours. If Monday bounces, Friday was a position-clearing event. If Monday doesn't bounce, Friday was the start of something bigger. This was the week the milestone arrived and the milestone fell, in the same 5 trading days. The bigger question is whether what we saw Friday was the rally taking a breath or the rally cracking. Next week we'll start to find out. That was the week. We cover the markets on the days that actually move, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.